Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. I'm answering a question. There's a couple of people who left comments, and even other people who were asking some questions. What does gold have to do with uranium? Why am I pricing uranium in relationship to gold? What does gold have to do with this? Well, gold, first I'll step back. On the downside, what I'm trying to do is I'm trying to put limits. I'm trying to put limits to a downside, but trying to put limits to the upside. The limits to the downside are pretty easily understandable. They once you go below the cost curves of the high cost producers and maybe even the middle cost producers, supply gets cut back, and usually what happens is the supply demand balance comes back into balance. So that's in a bear market. A bear market goes all the way down, the price goes below the high cost producers, and you find that balance. Most everyone can figure that out and say, yeah, that makes sense. The question then is, what's the upper limit? What is the upper limit? You know what everyone's going to do? They're going to look at each other, and then they're going to say, I don't know. Now, back in history, we can look at history to get clues of what upper limits are. Our currency was backed by gold. So essentially, through many, many years, gold was our money. And gold is nothing more than an inflation measuring stick. That's all it is. You have inflation, you have certain conditions, gold accounts for the money supply in the system. And it cycles back and forth against the money supply, accounting for the money that's been created during certain market conditions. Those conditions are an expansionary phase of real estate and during an increasing interest rate environment. That's what history has shown us. It's not me making this up, it's what history has bared. And I'll show you some history here. Now, to see the upper limit, all that oil, I'm going to take oil as an example. We have data all the way back, to the 1800s. And all it's done is go back and forth against gold between ratios, certain ratios. A 30-to-1 ratio is cheap. A 10-to-1 and below is expensive. That's the psychological threshold that humans put on the price of oil in relationship to gold. And gold used to be our money. Once they took gold away from the dollar, you have no idea what the actual value of a dollar is. It can be anything. And they manipulate it, they make it up, they say the inflation rate's this. That the dollar is literally nothing. It has no value. It used to be a claim check to gold, now it's a claim check to nothing. It has no value. It's whatever the value is that we assign it. And the more they create, it's just stealing value from the currency. So the psychological threshold has to be tied to something that has value. Something else that's another asset. You could do uranium to real estate ratio. You could do a ratio of anything. As long as the ratio over time holds true, it doesn't matter what it is. Gold just happened to be money. That used to be the gold standard. Now, I've got some information behind me. Commodities get priced in a twofold repricing. One is the supply-demand balance, which is the ratio against gold. The second is an inflationary rebalancing. The inflationary balance is when gold gets priced higher. So if the supply-demand balance, if this is the commodity and this is gold, if gold doesn't move, the ratio goes up and down of this, whatever commodity it is. It goes up and down. It's cheap down here. It's expensive at the top. It's cheap down here. And then you buy it when it's cheap and you sell it when it's expensive. That's the ratio. Now, if you're in an inflationary environment, and that's when you go from undervalued to overvalued of the commodity, your gold price is going up while you're getting revalued higher on your commodity. And you have an incredible opportunity to be invested in the commodity because you're getting repriced twofold. You're getting the repricing of money flowing into your asset, pricing it higher for the supply-demand balancing, and you're getting the repricing of gold higher, which then prices the entire commodity complex higher. And that's why, if you look, why they're shorting some of these metals so much is because they're trying to play with it. I don't know if they can control it necessarily, but they try to. And that's why they put all the paper contracts and shorts on the precious metals, because if they can hold that down, they essentially hold the whole commodity complex down, because that's your pricing mechanism. That's your accounting for money and the money supply. So here's a presentation I threw together, and it's just showing you some things. This is the gold to monetary base. Basically, if you're low, below 1, you're extremely low on gold accounting for the money supply. They created a lot of money and gold hasn't accounted for it when it's down here. Here is where we were on a gold-backed currency. Basically, 3.5 is a pretty good average, 3.75. Now, what I am showing here is two things. One, this was the 70s when we had a huge expansionary phase of real estate. We had a huge expansionary phase here and here. And this is just slightly delayed behind it. This here in the box is an increasing interest rate environment. This was a declining interest rate environment. It's showing us that gold accounts for the money system under inflationary periods, under increasing interest rate environments, because money flows out of stocks and bonds and into precious metals and commodities during those timeframes. And it does so rapidly. It gets repriced because of the conditions. What I'm saying is coming up is if we get interest rates that go up, we could get this same repricing like we did in the 70s. And the way that this thing is coming down in a descending wedge type pattern, and I'll throw that in, you could just kind of throw it in like this, is that this could get repriced much, much higher. That's the wedge pattern that I'm talking about. And if this moves on up, gold's going to account for the money supply, which then reprices everything. It'll reprice all the commodities higher. Basically saying we're in a huge inflationary period. This right here is telling us that we could potentially be going into an inflationary period by the chart pattern it has itself. Here's the 10-year interest rate. There's that box that I had of an increasing interest rate environment. We're declining here in this 40-year bear market in yields. What I'm proposing is that this could potentially break out. We already broke out once. We kind of pulled back for COVID, and I think we're going to move to the upside. It's a structural move. And under this type of environment here, we saw a great repricing of gold against the monetary base. It accounted for that money supply. I'm proposing that this could potentially happen again, especially after a 40-year bear market, and the demographics support it. The demographics and real estate supports an expansionary phase of real estate, which is inflationary. That's your gateway for money into the system. And it's important that everybody understands this, because that's where money gets into systems. That's how you get inflation. If you don't get inflation, you don't get the commodity boom that you want. Here's the gold to oil ratio back to 1950. The ratio trades between 30 and 10. You know, a little past 10, a little past 30, but basically between these two lines. We had a fluke because they shut down the economy. We've never shut down the economy like we did. And oil was still flowing. They can't just shut this stuff off. And it created this huge problem between demand and supply. And that's what your ratio showed you. Went off the chart. Now we're coming back. We're strengthening this ratio, and you're seeing massive gains in some of the companies that were sold off so bad. But this relationship over history has remained for 1860 all the way to 2020. Here's the ratios here. Yeah, it went to 40, blipped up a couple times, but mainly between 10 and 30. all the way back to 1860. These are the thresholds that people put on the oil price in relationship to gold. That's the thresholds. That's what people deem expensive and cheap. Uranium's no different, in my opinion. We went all the way up to 62 pounds. We had this anomaly of all the commodities being cheap, as cheap as they've ever been. And in 2020, we got to 62 pounds to 1 ounce gold ratio. On the bottom end, this is about a 1 to 3, 1 to 4 ratio and a 1 to 5. What I'm proposing is that we're probably going to compress down somewhere in that region. That is what people have deemed to be an overvalued uranium price against gold. Now, if I don't measure it against another asset that's inflation indexed, if I don't measure it against another asset, what do you measure it against? A dollar that's gone down 90%. So you think that us completely exploding the money supply since last uranium boom, that you think you're going to go right back to the top of the uranium boom of 140 or somewhere around that area and just stop, even though you've got a whole bunch more money in the system? I don't think so. I think we're going to blow past it like it's nothing. Now, there's a lot of people, they're talking about uranium, they're talking about how long it may take. Guys, this is not supply-demand driven anymore. It's financially driven. Sprott, I mean, maybe you could say it is because Sprott is buying physical pounds, but it is financially driven. There's something else demanding uranium outside of the natural cycle. So then the question would be, when is it going to happen? I don't know when this is just going to absolutely explode higher, but it's financially driven right now. It's the supply-demand balance. That demand is financial demand for physical pounds. It's a different game now. It's not the same game that it was before. This could blow to the upside of it. I should say the downside of how much it can compress. And we could get a whole bunch of volatility if people are buying and selling, because you could put pounds back into the market as well. But it's important to anchor your pricing against something. If you don't anchor your pricing against anything, then how do you know what the value is? If gold's the measuring stick against the money supply, then I would price it against gold because that's your measuring stick. That accurately inflation adjusts the price. So a uranium to gold price is just an inflation. A uranium to gold price is an inflation adjusted price. That's all it is. Now, if you go back to the gold to monetary base that I have up here, and we were to go back to a 3.5 ratio, or a 4 ratio, or a 5, if we're down here at 0.4 and we go to a 4, that's a 10x up. That means gold can go 10 times up and account for the money supply like it did in the 70s. In the 70s, it went almost all the way to 5. Maybe it's a 12x. It's 12 times from where we are today. You know, that's $20-something thousand gold. If uranium usually hits, you know, at 34, 35% of the top of the gold price, so now you're looking at like $4,000 gold, or yeah, $4,000 gold. I mean, you could have, and the compression goes all the way to 1 to 5, somewhere in that range. You're at like $800 gold, or $800 uranium. Sorry, $800 uranium, and that's just an inflation-adjusted top. That's all it is. Gold is a measuring stick. And if you guys don't believe this, you really need to start studying history and looking at the financial markets. These ratios in terms of asset versus asset just cycle against each other. It's basically telling you tops and bottoms. The bottoms, what I would do is look at the cost curves for a commodity. And then I look at the ratio to see if it's cheap. The ratios told us that we should be buying all of these things and the cost curves going below the high cost producers. Platinum did it, silver did it. They've all done it here recently, past couple of years. Uranium, guess what? It's no different than the other commodities. Uranium's a commodity, and guess what? Uranium, if you look, here's the ratio there. Uranium's no different. It accounted for the money supply here in 76. It's a commodity. And it went cheap during a phase, and then it got back expensive during last commodity bull market. I mean, uranium's no different than any other commodity. It's no different. There's nothing special about it. It accounted for it the same time gold did last time. And the same thing happened with oil. They're all tied together. And these people who think that uranium's completely different than everything else, it is not. Because if your gold goes down, if it goes down, I'm willing to bet that when you lose that one component, that you're not going to have as big of a boom. It's going to be a much smaller boom because gold price is going to be at a far lower level. You still have a boom. You go to 1-to-5 ratio of gold at 2,000 is much different than a 1-to-5 ratio of gold at 4,000 or 5,000. But gold, the commodity prices almost always revalue when gold is going higher. In an expansionary phase of real estate, which has happened every single time in history, which we're entering right now. It's just no coincidence that we're entering an expansionary phase of real estate and oil and all these commodities are going up. It just so happenstance to line up like that. All these things are interconnected. It's not by happenstance. Oil's going up, uranium's going up, they're all going up at the same time. It happened in 2000, it happened in the 70s. Expansionary phase of real estate, and we're going into an expansionary phase of real estate. If we get interest rates to go up, which they almost always do in an expansionary phase of real estate, we're going to see a big money flows start to move. And uranium gets repriced, along with oil, along with coal, along with everything else. That's a commodity. Copper. But I wanted to go over that. I wanted to make sure that you guys understood this because it's important. Now you know where the bottoms are. You look at the cost curves, and the tops, you do the ratio. You anchor it to the gold standard. And more than likely, the tops will be somewhere around what we have here of a 1-to-5 ratio for uranium, 1-to-3, somewhere in that range. That's what history has suggested us. And the pricing, absolutely insanely high for what most people think. That's what history has shown us. To go to a 1-to-10 ratio or 1-to-20 ratio, well, that would be out of historical norms. Because if gold's at 2,000, a 1-to-10 ratio would be a $200 gold price. And that would be like an absolute low price because gold's going to count for stuff and it's going to go higher. And when we compress against that, I think we're going to compress below a 1-to-10 ratio against gold. All right, guys, that's my opinion. If you guys like the content, give me a thumbs up. Thanks for listening. This is Finding Value.